Navigating taxes and fees in investing. When it comes to investing, two things often eat away at your returns without you realizing it: taxes and fees. Even if your portfolio is performing well, these silent costs can reduce your wealth over the long run. Let's break them down step by step. 1. Understanding investment taxes. Taxes depend on the country you live in, but in the U.S., where most of my examples will apply, here's the breakdown. Capital gains tax. Short term, less than 1 year. Tax is regular income. Long term, 1 year or more. Usually taxed at a lower rate, 0%, 15%, or 20% depending on your income. Dividends tax. Qualified dividends, taxed at long-term capital gains rates. Non-qualified dividends, taxed as regular income. Light bulb example. Imagine you invest $5,000 in Apple stock and sell it 6 months later for $6,000. That $1,000 profit is short-term and will be taxed as if it's part of your salary. If you had waited 12 months, you'd likely pay a much lower tax rate. 2. Tax advantage accounts. One of the best ways to minimize taxes is by using accounts designed to help you grow wealth. For 401k/IRA US, invest pre-tax traditional or post-tax Roth. Your money grows tax-deferred, or even tax-free in some cases. HSA Health Savings Account, a triple tax advantage, tax-deductible contributions, tax-free growth, and tax-free withdrawal for healthcare. Open book story. Sarah, a nurse in Indiana, invested $200 per month in her Roth IRA. Over 20 years, her portfolio grew significantly, and she didn't have to worry about paying taxes on withdrawals in retirement. That's the power of planning ahead. 3. Understanding investment fees. Fees may seem small, but they can drastically reduce your wealth over decades. Expense ratios, funds/ETFs, a percentage charged annually by the fund manager. Trading fees. Some brokers charge per transaction, though most U.S. brokers are now commission-free. Advisory fees. If you hire an advisor, they may charge 1% annually. Light bulb example. If you invest $100,000 and your advisor charges 1% per year, that's $1,000 annually. Over 30 years with compounding, that fee could cost you hundreds of thousands. 4. How to reduce fees and taxes. Choose low-cost index funds or ETFs. Expense ratios under 0.1% are ideal. Take advantage of tax advantage accounts first before taxable ones. Hold investments long-term to qualify for lower capital gains tax. Rebalance your portfolio wisely to avoid unnecessary taxable events. White heavy checkmark key takeaway. Every percentage point counts in investing. By being smart about where you invest accounts and what you invest in low-fee options, you keep more of your money working for you, not for Uncle Sam or your fund manager. Bar chart example. The cost of fees and taxes over 30 years. Imagine two investors, Alex and Jordan, both starting with $10,000 and investing $5,000 per year for 30 years. Both earn an average 7% annual return. Investor fees/taxes net return after 30 years final portfolio value. Alex pays 1% annual advisor fee plus invests in high-fee mutual funds. 6% return net $472,000. Jordan uses low-cost ETFs, 0.05% fee, plus invests in a Roth IRA, tax-free growth. 6.95% return net $574,000. Light bulb difference. Jordan ends up with $102,000 more simply by avoiding high fees and taxes. That's money that can fund retirement, buy a house, or send kids to college without investing a single extra dollar. Key message for investors. It's not just about how much you invest. It's about how much you get to keep. Cutting unnecessary fees and planning for taxes can be the difference between financial stress and financial freedom. Retirement planning and financial freedom. Retirement planning is not just about stopping work. It's about building the freedom to live life on your terms. Whether that means traveling the world, spending more time with family, or simply not worrying about money, retirement is a reward for smart, consistent investing. Key step 1, define your retirement vision. Before crunching numbers, ask yourself, do you want a modest lifestyle or a luxury one? Will you retire early or work part-time? Where do you want to live? This vision shapes how much money you'll need. Key step 2, know the retirement rule of thumb. A widely used benchmark is the 4% rule. If you withdraw 4% of your portfolio each year, there's a good chance your savings will last 30 plus years. Light bulb example. If you want $40,000 per year, you'll need about $1 million saved, $40,000 divided by 0.04. Key step 3, use retirement accounts wisely. 401k/403. Be employer-sponsored plans with tax advantages. Some employers match your contributions, free money. IRA/Roth IRA. Individual retirement accounts with tax benefits. Roth IRAs are powerful because withdrawals in retirement are tax-free. HSA, Health Savings Account, doubles as a retirement account since healthcare will be one of your biggest costs. Key step 4, diversify for retirement security. Don't put all your eggs in one basket. A good mix might include stocks, ETFs, index funds growth over the long term, bonds, stability and predictable income, real estate/REITs, cash flow and diversification, dividend stocks, passive income streams. Key step 5, estimate future expenses. Think beyond housing and food. Healthcare costs, huge in the U.S. Inflation, your $1 today won't buy as much in 20 years. Travel, hobbies, and lifestyle choices. Key step 6, financial freedom mindset. Retirement isn't just about a specific age. It's about financial independence, FI. The earlier you build assets that cover your expenses, the sooner you can live life on your terms. Sparkle's mini store example. Linda started investing $500 per month at age 25 into index funds inside a Roth IRA. By 55, she had over $1.2 million saved. She retired early, traveled with her husband, and volunteered, proving that consistent investing beats trying to time the market. Glowing star key takeaway. Retirement planning is not about luck. It's about consistent investing, smart tax planning, and a vision for your future. Every dollar you invest today is a step closer to freedom tomorrow. Avoiding common investing mistakes. Even the smartest investors slip up. The difference between success and failure often comes down to avoiding the most common pitfalls. Let's break them down so you don't fall into the same traps. Cross-mark mistake 1, timing the market. Trying to predict the exact high and low is almost impossible. Even experts get it wrong. White heavy checkmark better strategy. Focus on timing the market through consistent investing, dollar cost averaging. Let compounding work for you. Cross-mark mistake 2, not diversifying. Putting all your money in one stock or sector is like standing on one leg, risky and unstable. White heavy checkmark better strategy. Spread investments across stocks, bonds, ETFs, and real estate for balance. Cross-mark mistake 3, emotional investing. Fear and greed are the enemies of wealth. Many investors panic during market dips or chase hype when prices are inflated. White heavy checkmark better strategy. Stick to your long-term plan. Remember, markets recover, patience pays. Cross-mark mistake 4, ignoring fees and taxes. High fund fees or unnecessary trading can eat away at your returns. White heavy checkmark better strategy. Choose low-cost index funds/ETFs and understand tax-efficient investing, Roth IRAs, for 01k SHSAs. Crossmark mistake 5, investing without a goal. Investing blindly without clear financial goals is like sailing without a destination. White heavy checkmark better strategy. Define your goals, retirement, home, education, or passive income, and align your investments. Sparkle's mini story example. Jake invested in a hot stock everyone was talking about on social media. He bought high, panicked during a dip, and sold low, losing thousands. Later, he switched to index funds, stuck with plan, and grew his portfolio steadily over 10 years. Glowing star key takeaway. Wealth isn't built by avoiding all risks. It's built by avoiding the most common mistakes, staying consistent and thinking long-term. The psychology of money and investor mindset. When it comes to building wealth, your mindset matters just as much as your money. Many people lose not because of bad investments, but because of bad decisions driven by emotions. Brain 1. Money is emotional, not just logical. People save, spend, and invest based on fear, greed, pride, or security, not spreadsheets. Recognizing this helps you make smarter choices. Light bulb example. Someone might keep too much money in cash, not because it's smart, but because they're afraid of the stock market. Brain 2. The importance of patience. Most people want to get rich quick. The reality? Wealth is built slowly. The best investors are often the most patient ones. Light bulb Warren Buffett made over 90% of his wealth after age 60. Proof that compounding takes time. Brain 3. Avoiding herd mentality. When everyone is rushing into a trend, crypto, meme stocks, real estate booms, it's tempting to join, but following the crowd often leads to losses. White heavy check mark instead. Focus on your goals and long-term plan, not hype. Brain 4. Developing an abundance mindset. People with a scarcity mindset fear losing money. Those with an abundance mindset see money as a tool to grow opportunities. Light bulb tip. Reinvest your profits instead of spending them. Let your money work harder than you do. Brain 5. The role of discipline. Your biggest asset isn't your portfolio, it's self-control. Avoid panic selling during downturns. Stick to your strategy even when markets are volatile. Celebrate small wins. They build momentum. Sparkle's mini story example. Sophie invested steadily in index funds for 15 years, ignoring hype cycles. Friends mocked her for boring investments while chasing quick money. Years later, Sophie retired early with financial freedom, while many of her friends were still chasing trends. Glowing star key takeaway. Wealth building is 80% mindset, 20% mechanics. If you master your emotions, stay patient, and stick to a clear plan, financial success becomes inevitable. Watch out for next chapter.